Joining me now on how Intercontinental Exchange can help borrowers navigate the cost of owning a home these days is Andy Walden. He's head of mortgage and housing market research at NYSE. Andy, welcome.
Good morning, Kristen. How are you?
I'm good, thanks. Great to have you on the show this morning, of course, at the start of each month. And what did this month's report reveal about the rising cost, as you've spoken about before, of property insurance?
Yeah, we continue to see those property insurance pressures push higher. The average policy premium rose by about $275 this year. That's the highest that we've ever seen. Over the last 5 years, it's now up $872, or about 60% more than it was 5 years ago. So we continue to see pressure being put on the market out there in terms of higher property insurance premiums as the frequency and the cost to rebuild in the wake of some of these natural disasters continues to push higher.
How are the trends varying by different region or even market?
Yeah, and when you look at it over the last 5 years, it's somewhat as you'd expect, right? Gulf Coast, we all know that there's more hurricane risk and rising insurance premiums down there, and so that's where you're seeing the pressure over the last 5 years. 2024 was an interesting year. When you look at that Gulf Coast, it was more in the 5 to 6% range in terms of property insurance rises versus a 14% rise nationally. The larger increases this year came in the western U.S., places like Seattle, Salt Lake City. Unsurprisingly, Los Angeles saw one of the largest increases on a percentage basis this year. When you look at the rising cost by just simple dollar amount, Texas stands out. Dallas, the average mortgaged home is paying about $600 more for insurance than they were last year. That means on a monthly basis, you're paying about $50 more for property insurance in Dallas than you were last year. And in Houston, it's about $40 more per month than you were at the same time last year. So again, it's kind of shifted away from just hurricane-prone markets, just your Gulf Coast, to seeing rises in some of these other areas of the country as well.
Interesting, Andy. So how have you seen borrowers respond to these rising costs?
In a couple of different ways. One is shopping around for better policies and better premiums. And so we saw over 11% of borrowers switch insurance providers. Now, some of that has to do with non-renewals and insurance companies backing out of some of these higher risk markets across the country, but folks also shopping for better policies out there across the country as well. The second, and I think this one's more interesting, is our climate team is starting to pick up on folks taking on higher deductibles to start to offset some of those rising premium costs out there in the market. So for example, a homeowner that took out their mortgage in 2024 was paying about a 19% higher deductible on average, but they were getting about a 12% lower premium. And so folks taking on higher deductibles in the case that something happens on their home and exchanging that for lower monthly payments to improve their cash flows.
Interesting. So how can ICE help with all of this, make this process easier, and certainly help buyers comparison shop?
Yeah, it's a great question, and we're doing that across the loan's life cycle, right? So we have integrations if you're taking out your first mortgage and you're going through our Encompass platform, or your lender's going through our Encompass platform. We have integrations there to help folks shop for insurance on their home. And again, you're seeing those savings kind of make their way into the market. Folks that took out their mortgage last year are saving about 12% on insurance by shopping and comparing against other providers out there in the market. We also have integrations for folks that have already become homeowners and are maybe going out there to make their monthly mortgage payment through our servicing digital platform. You can shop for insurance through that platform as well, and making sure that you're tuned in on, not being overcovered. We certainly don't want folks undercovered out there in the market, but make sure that you're not having too much coverage, and making sure that your policy is tuned and you're in the most cost-effective policy as well.
This report does take a quarterly look at home equity levels. Andy, something I know that you've spoken about on the show with us before. What did it reveal on that front?
Yeah, we actually see that folks enter 2025 with more equity in their home than any other year on record. And so we're continuing to see an equity-rich housing stock and equity-rich mortgaged homeowner stock out there in the market as well. The average mortgaged home has over $300,000 in equity right now. They have over $200,000 in what we call tappable equity that they can access in their home while still maintaining a relatively safe 20% equity cushion. And what we've also seen is, as the Fed's been reducing rates, it's become more cost-effective to borrow against that equity as well. The average introductory rate on a home equity line of credit is down 1.7 percentage points from where it was at this time last year. It means that folks looking to consolidate some of that debt or maybe do some renovations on their home can access that equity at a more affordable level than they've certainly been able to over the last couple of years, which may create a little bit of a tailwind for some of that activity as we make our way through 2025.
We've seen rates be sticky throughout this process of late. Has your outlook changed at all there when it comes to rates, Andy?
Yeah, and there's some good news for homeowners here over the last few weeks. If you look at our ICE 30-year conforming fixed rate index, it shows that loans flowing through our origination channels over the last couple of weeks, the average interest rate has dropped by about 0.25%. So some good news from an interest rate perspective for folks going out there and shopping this spring. The other good news is when you look at our ICE futures market and you look at where futures of 30-year mortgage rates are trading out there today, that's also improved, right? And if you look at what that implies for 30-year rates, it says, hey, maybe rates come down by another 0.25%, 30 basis points as we make our way through the summer months, or at least that's what the market is currently anticipating. So potentially some good news there in terms of interest rate easing that we've already seen over the last couple of weeks, and maybe some additional easing as we make our way through the spring and summer.
Andy Walden, great to have you on the show. As always, of course, at the start of every month with the Mortgage Monitor. Andy's the head of mortgage and housing market research at ICE. Andy, thank you.
Thanks, Kristen.